Hello, good morning, everybody, and welcome to this month's edition of the Pulse webinar from Novia Global. It's great to be joined once again by Marlborough, and this month Nathan Sweeney will be with us and giving us an overview of last year, which was a strange year in many ways, where we had an erratic president, headlines around AI, wars, geopolitical tensions left, right, and centre. So I'm sure you've been having conversations with your clients around this and what that means going into 2026. So to help you make sense of all of this, Nathan's going to give an overview of last year and look forward to 2026. In the usual way, the session this morning will last 25 minutes or so, and we'll have time at the end for Q&A. And if you do have any questions, please use the button at the bottom of your screen to pose those questions, and we'll run through those with Nathan after the main body of the session today. So without any further ado, I'll hand over to Nathan. Thank you.
Okay, so good morning, everybody. Hopefully you can all see the slides on the screen. So firstly, Paul, thank you very much for the intro, and really looking forward to providing a good session today where we talk through what was happening in markets last year. But ultimately, the way I wanted to frame it was, I think it was a challenging market for a lot of investors because you probably saw multiple instances where you questioned, investing. Should I stay invested? So I want to talk through it from that perspective. So let's have a look. Okay, so let's start off with last year. So for me, it was very much a year of transition. So we did see, several reasons for investors to be cautious. But what I want to do is actually talk about that, but then also talk about reasons why I believe investors should be optimistic about 2026. Because I think it's very easy to get into that kind of negative spiral where we focus too much on all of the negative media and all of the negative news stories. And ultimately, that prevents us from meeting our financial goals because we lose our way in terms of investing and maybe decide that, there's too much risk involved. So the key thing I wanted to talk about was just three instances last year where I think investors really looked from the sidelines and thought, actually, something's happening here in markets which is catastrophic. And so I think that the first one was Liberation Day. So I think if you kind of remember back to Liberation Day, emotionally for a lot of people, this will have been something which was quite distressing. So they will have seen the Liberation Day tariffs, which Donald Trump basically unveiled to the world, and stock markets didn't like that at all. So Trump came out with these notional tariffs that he was going to impose on countries around the world. And the initial reaction was a huge sell-off in equity markets. There was concerns about supply chain disruption. There were concerns about this higher tax, because a tariff is a tax. This higher tax would lower growth, would increase inflation, and markets sold off by almost 20%, which is a big number. And generally, investors went from being pretty positive about the world to being pretty negative about the world in a very short period of time. But then something happened. So ultimately, we saw the Trump administration backtrack on these tariffs. And so from our perspective, it's always trying to understand what the Trump administration was trying to achieve and what that meant for markets. So we always felt that, from the Trump administration perspective, what they wanted to do was to force countries to negotiate on trade. But ultimately, if you are a country and the US says to you, can you come and have a conversation about our trade agreement? It would probably take a very long time, and some countries might be reluctant to do that because they might feel, actually, if we do sign a new trade deal, it's not going to be good for us. So let's delay that conversation. And so the whole point in terms of Trump's tactic was to force governments to the table. And this is something which I'll talk about as a theme in the portfolio. So he's forcing basically governments to come to the table, because when you unveil tariffs at such a high level, what that means is that you have companies in every country ringing up their politicians and saying, you have to fix this because this is going to cripple our business. So, what that did was it forced leaders from around the world to go to the US and negotiate. If he didn't unveil this board and if he didn't go through that tactic, none of the deals which are in place today would actually be in place today because trade deals take an enormous amount of time. And he was trying to force the issue and accelerate the process. But we've kind of witnessed one thing with Donald Trump, and it's his kryptonite. The thing which causes him to weaken is the stock market. And because the stock market sold off so aggressively because of the Liberation Day announcement, he backtracked. And so this is called the taco trade. Trump always chickens out. And what he did there was he said, actually, those tariffs which we're looking to implement, we're going to give 90 days for these negotiations to happen before they go live. And then he kind of pushed some out further and further. And as soon as he did that, the market recognized that that was his weak point and that, yes, it was a negotiation tactic, but he would only push it so far, ultimately, because he doesn't want to be in a position where the market sells off, because when he was voted in to create a strong economy. So people want a strong economy because it's linked to their pensions and their finances. So they want good, strong market activity. So that was the first thing. But I think from an investor perspective, it was all about, the swing of emotion from greed to fear in a very short period of time. And then for some investors, unfortunately, they would think, actually, look, this thing has happened in markets. This is a signal to me to time the market and exit the market, which, as we all know, would have been a terrible decision because we then saw one of the strongest and longest rallies we've had in equity markets post Liberation Day because Trump changed his tact, or he tacoed out, he chickened out ultimately. Okay, so the second thing I think that investors got excited about last year was the gold price, but this is kind of thinking about it from a totally different perspective. So on one side, we have investors fearful, and then on the other side, we have investors who are greedy, that fear and greed theme playing out. And what we saw here was the gold price going up a lot in 2025. And as a result, investors wanting to take advantage of that. The share price is going up, therefore I should invest in that. So if we look at 2024, what this chart shows you is it shows you flows into exchange traded gold funds. So basically, these are just products which track the gold price and which you can get access to. And you can see that the flows throughout the whole of 2025 were dwarfed, or sorry, the flows throughout the whole of 2024 were dwarfed by the flows in 2025. You just saw a lot more money flowing into gold in 2025. A couple of reasons for that. Firstly, you had Russia-Ukraine war, and ultimately, as a result of that, you saw sanctions on Russia, which just meant that when the Russian central bank is buying US government bonds, the US government decided we're going to sanction those assets, keep a hold of those assets. Now, if you're a central bank anywhere in the world and you just see that the US central bank has seized money that you have invested in US government bonds, it's going to remove your appetite for buying US government bonds in the future. Why would you do that? Because they could sanction you. So if you're China, if you're Turkey, if you're India, your central bank is now highlighting this as a risk. So what you're doing then is saying, well, I need to diversify into some other investment. So instead of buying US government bonds, I'm going to buy gold. So that was the key driver of that theme. And that was the key reason why you saw a huge increase in appetite for gold. But because the gold price was going up, you then had retail investors saying, well, I want to take advantage of this too. And I did a chart of the week on it, and I discussed the fact that in Australia, there was a bank where people were queuing up outside the bank to buy gold bars. And when they were asked by the journalist, why are you queuing up to buy gold? Some of the answers were because the price of gold is going up. So that's not a rational investment. That's an irrational investment. And it just shows you the other side of the coin. where people are, trying to take advantage of what's happening in markets, and ultimately then is that a good investment? So not necessarily a good way to invest. So yeah, something I think which I suppose investors should just be quite mindful of is just kind of buying investments just because the share price is going up. Because what we saw then is you've seen this kind of change in rhetoric between the US and Russia. So the US is now basically, and this is a negotiation tactic from Trump's perspective, is openly welcoming Russia back into the investment community. So Russia has been outcast because of the war in Ukraine, and nobody wants to deal with Russia, and there's lots of sanctions, whereas Trump appears to want to deal with Russia. But the reality is he just wants to be able to get Russia to the negotiation table because the Ukraine war is costing the US government money, and they don't want to continue to fund it. They want Europe to fund it, and they want to remove that cost from their balance sheet. And the best way to do that is to negotiate peace. And the only way to do that is to bring Russia back into the investment community. So on one side, he's opening the door for Russia to come back to the investment community. But on the other side, he's forcing him to the table. And the way he's doing that is through the oil price. So we saw Venezuela at the beginning of the year, helps to lower the oil price. And then secondly, you're seeing Ukraine bombing strategic oil infrastructure in Russia as well, using the US intelligence. So opening the door on one side to get him to the negotiation table and forcing him through on the other. Why is that relevant? Because it removes one of the reasons why the gold price was going up in the first place. Because if there's a deal between Russia and Ukraine, it means that those sanctions can get lifted, and therefore there's less impetus for central banks to buy gold if they see that the US government is actually not sanctioning those assets. It's changing its view on that. So something to watch out for on that side. Now, the other thing which investors do is sometimes they wed themselves to what you would call a political risk. And the whole point there is that sometimes investors think that a change in government is going to change their financial fortune. And the reality is that it rarely does. Because ultimately, what tends to happen is governments are in place for, call it 44 years or 5 years, depending on where it is. And it just means that changes in taxation can happen all the time. So you shouldn't bank on, if this government gets into power, that's going to meaningfully change my financial position. It shouldn't really. The thing that meaningfully changes your financial position is investing and saving over time, longer periods of time. The point here is that there was a lot of media hype leading up to the UK budget and what that might mean for people's personal finances, pensions, etc. And there were cases where people were taking out tax-free lump sums from pensions, and then after the budget was announced, saying, actually, can I put that money back in? So it's just to be mindful of not trying to second guess what may happen, because obviously after the budget was announced, we saw this patchwork quilt of initiatives. So there was no real big initiative, which was, kind of focused on pensions, etc. Obviously, some changes in the previous year for international investors, but at last year's budget announcement in the autumn, basically a lot of people overreacted. So we would say not to put too much weight on politics, in that it can change policy, but those policies can swing back the other way. So it's not really kind of in that long-term investing mindset. So something just to be aware of as well. So I think, there, what that really does is it gives you three kind of key instances throughout 2025, which could have caused investors to try to time the market. And we talk about timing the market investing all the time. And the reason we talk about it is actually trying to time markets is very difficult. So when Liberation Day was announced, your rational response would be sell the market. And ultimately, the market tends to work in the opposite way. And what we saw then was that would have been a bad decision, because the market continued to perform on up. and very quickly post-Liberation Day. Then secondly, you might think rationally, look, the gold price is going up, therefore I want to take advantage of that, and you might want to buy that. And what we saw towards the end of last year, because of the way in which the US was courting Russia, but you remember the motive. The motive is to remove Ukraine off the balance sheet. It's a funding exercise for the US and to broker peace, but forcing Russia to the table from behind using the oil price. So it's important to remember that, for things like the gold price, when the price is going up, you shouldn't chase that either. And again, that's an emotional response. It's going up, therefore I should buy some. And then the last thing there was just, again, is not to wedge your, I suppose, financial goals to something external, like a change in politics, something you can't really control. The thing you can control is the amount of money you save and how long you save for, and not trying to time the market and make those missteps, which are very, very common in investing. So I just thought last year was a really great way to express and demonstrate that, because we know that by the end of 2025, we did see good performance across the board. And this is despite all of those events that happened throughout the course of 2025. So it actually turned out to be quite a good year for investors. So how would you feel actually if you did exit the market back in April? Now, the other big thing which took center stage last year was around bubbles. So at the end of the year, towards the end of the year, we had Andrew Bailey coming out and warning about froth in AI, and Jamie Dimon talking about market bubbles. Now, the first thing I would say is that no commentator is right on everything, and people often say things and it ends up in the media, and maybe they're right, maybe they're wrong. That's the first thing. So the way I would think about it logically is I would want to understand the definition of a bubble. So what is a market correction? What is a bear market? What is a stock market? What is a bubble? And the stark reality is that we have market corrections every single year. And Liberation Day was a great example of that, where stock markets sold off almost 20%. And that's just a standard market correction, because market pullbacks of 5% happen every single year, multiple times a year. They can happen in a week, but then markets can be up 5% the following week. So this chart here is just showing you the various different definitions we have. So we've got market correction here. This is a pullback of anything up to 20%. And this is just investors basically swinging from fear to greed and greed to fear. And we saw that with Liberation Day, and we saw that with the gold price. And generally, when you get those swings in investor sentiment or feeling, everything just gets sold off, everything gets bought, so it kind of just moves from one side to the other. And, would you believe it if I told you that the average sell off in the US market every single year, going back to 1950, is 14.8%? It's a big number when you think about it, but when you're experiencing that, how does that feel? It doesn't feel great. You want to react to it, but the point is you shouldn't, because these things are quite common and very normal. I would say that volatility is the price you pay for investing. This year, it's just part of the journey. And then we have what we call a bear market. So a bear market is a technical term which refers to a sell-off of 20% or more. Interestingly, bear markets happen on average every 5 years. So again, these things come along and they do happen. Generally, it's linked to a recession. When you get negative economic growth for 2 quarters, that's the definition of a recession. When you get a slowdown in economic activity and it turns negative, then you tend to get what they call a bear market. And bear markets tend to last for just over a year. But then the rallies that come after that tend to last for an average over 5 years, and the returns are much greater. So you're almost thinking of markets going up in this kind of lockstep action over time. But the thing I have a slight grievance with is that the word bubble gets used all the time now. And one of the reasons behind that is that, the media wants to sensationalize everything. If there's a 5% move in market, a slight correction, people are calling it a bubble bursting. Everything's a bubble. The gold is a bubble. AI is a bubble. Private credit is a bubble. So if I read the media, then I think everything is in a bubble. This puts me into a state of nervousness about investing and risk off in general. And the whole point is, look, that's not necessarily true, because a lot of the I suppose media and news publications that are published, they're specifically designed to engage you and to get your attention. And the reason behind that is because if you click on it, it generates advertising revenue for some media outlet. So of course they're going to describe everything as a bubble. Of course they're going to sensationalize everything, but that doesn't do anything for managing how you think about investing. And that's, I think, one of the biggest challenges we're going to face today. And I think with AI, it is only going to get worse, because now I think it's over 50% of all content that is produced, marketing content, is now coming from AI. And think about, how the AI generates those clickbait titles or headlines. So just something to be aware of. So people are talking about the fact that AI is a bubble. So when you have a bubble, you have to remember that share prices basically move to levels which are just beyond recognition. And I'm going to talk about that in the next slide. I'm going to show you an example. And you get this state of euphoria in markets and this fear of missing out, where people just expect, look, this thing is just going to continue forever and there's no questioning it. And today, I don't think we're there, because I can still see fear and greed playing out within the markets. So we're still kind of in the middle of the cycle. So what I have on the next slide is I've got two separate charts. And one chart is showing you a company called Cisco, and the other chart is showing you a company called NVIDIA. And what I have here is I have basically, there's a way to measure if a company is cheap or expensive. It's called the PE, so the price to earnings ratio. And if I look at the PE, so let's say the price of a company is £100 and the earnings is £10. If you divide 100 by 10, you get a PE of 10. So what that means logically is if the share price doesn't move, the level of earnings that that company delivers over the next 10 years will equal that share price. So you get paid back how much you've spent on that share in earnings over the next 10 years. So if we look at the PE of Cisco, so Cisco was one of the big names back in the year 2000, so the dot-com bubble. And if we look at the PE for that stock, the PE of that stock got over 200 times. That's colossal. So it would take you 200 years to get back the earnings if the earnings stayed the same from the amount of money you put into that share price. So what are you expecting when you're doing that? You're expecting the growth of this company to be parabolic in the future. This company is doing something so game-changing that it's worth paying that price today, because people got into such a euphoric state about the potential for the internet, and that's what was happening in the dot-com bubble. And so what I have to the right of that chart is I've got this bar, and the bar, you've got some pink on there and you've got some blue, and basically it's just showing you the return over that period and the composition of that return. And it's just showing you that that return is driven by something they call multiple expansion, and that's just the share price going up. And the other thing is EPS growth, so that's the earnings the company is delivering. So was the share price move being driven by actual earnings the company is generating, or just euphoria about the potential for this company to deliver in the future? And for Cisco, it was all about the hype. People believing that this thing was going to do something exceptional in the future. Bubble. Now, the very interesting thing for me is that the share price move from 1990 to 2000 for that company was 98,860%. Euphoria, that bubble territory. Now, the company which is being talked about today is NVIDIA, and the comparison between the share price move of NVIDIA compared to Cisco. And I can see the chart doing the rounds on LinkedIn, etc., and people talking about bubble. So let's look at NVIDIA. So if we look at the PE for NVIDIA, the PE for NVIDIA is less than 20. So that's over 200 versus 20. So it's not an expensive company. And then if I look at the composition of the return over the last 3 years has been 1,455%. But the composition of that return, the majority of it has been driven by company earnings. So this is the company actually selling stuff, making money from selling that stuff, and the share price going up as a result of them making lots of money. So to me, that's very different. So we've all of this concern about AI bubbles, and I can see here that actually, look, it's a very different if I'm trying to compare the dot-com bubble versus today. Now, arguably, that could continue the share price of NVIDIA and it could get to those parabolic levels. And the share price could get divorced from reality or from the earnings, but that's not happening today. So that I just thought that was really important to kind of talk about that, because I think, again, there's a lot of misinformation circulating about that at the moment. Okay. And some of that concern is around the fact that we're seeing these big tech companies spending a lot on AI. And these tech companies are now being rebranded as AI companies. And I think, again, that's false. It's a false narrative. It's a false story, because these are companies that all do very different things. So Tesla is not an AI company. It sells cars. Apple is not an AI company. It sells phones. Amazon is not an AI company. It sells stuff online. Google is not an AI company. It sells advertising through search engines. So the point is, Microsoft sells software. They are not AI companies. They are companies who have revenue streams which are driving growth today, generating cash today, and they are using that cash to invest in a new infrastructure that they believe will drive revenue in the future. And that new revenue stream is basically building language models. So using NVIDIA's microchips to process information at faster speeds to do things better. And the way I think about it is, if I think about years and years ago, you had Henry Ford, and he brought basically almost trying to automate the manufacturing of cars. So, okay, over here, you guys do the tires, you do the riveting, you put in the seats. So creating that production line. And now we've got the automation of that production line. We've almost got robots building the whole thing. And we operate in a world, so if you're working in the office space, where there's a huge amount of administration and not enough automation. So the way to think about AI, what the AI is really about, is bringing automation to the workplace. So removing a lot of the admin, which we're doing today. So it's that progression. And ultimately, when there's a new technology, obviously it'll be feared, but also people will potentially underestimate its potential. And the way I would, again, kind of frame this is, think about the number of jobs today which are linked to the internet. It's a big number. And think about the number of jobs which existed 50 years ago or 60 years ago, which don't exist today. And that's just part of innovation, growth, and change. And if you think about the evolution of any cycle, it doesn't happen gradually. It happens, and you get an event that causes a leap. And what we're seeing today is we're on the cusp of a leap, because we've got this new technology which has the potential to really unlock the administrative burden for a lot of office work, which ultimately means we can all be more productive and focus on the tasks which actually drive growth, and productivity increases as a result of that. So this is why the big tech companies really want to spend on this, because they see the potential of it reducing a lot of the friction within their own workspace, and say, actually, this could really help lots of companies. So it's why they're all spending so much money. But the way to think about the AI companies versus 2000, in 2000, you had companies who were thinking of ways to monetize the internet in the future, and they were borrowing money to do that. And when they didn't actually achieve that, they went bankrupt because they didn't have money in the first place because they borrowed it all and they had all this debt. Whereas today, you look, we've got all these big, incredible companies who were selling various different things, making lots of money from doing that, and they're taking that money and investing it in a new venture. If it doesn't work out, they've still got their old business. So it's just understanding the difference. So our expectation is, look, we're going to get more spending this year on the build out of AI, and we've seen lots of announcements from companies, and that's the case. They're looking to really spend big on this, but the point is they're using cash that they have. They're not borrowing to do it. Some private companies are, some individual companies, but not the big Mag 7. Okay. So hopefully that's just giving you some insight into last year. Look around the kind of the way you think about timing, and hopefully that's giving you a greater understanding of what a bubble is versus a bear market versus a correction, and the comparison between last year and this year, and the types of companies which are investing in that space today. But what I wanted to talk about quickly was just reasons to be optimistic for 2026, because I think given the backdrop of last year, it's very easy to be negative. And I also mentioned that given the backdrop of the fact that we live in this fast twitch social media world where there's so many negative news stories which are just there to generate ad revenue, that makes the task even harder. So I'm going to go with reasons to be optimistic. So the first is, in the US, they've passed a bill. So this is basically legislation, which means that you're going to see increased spending. So what this legislation does is it reduces corporation tax, or prevents it from going up, because they reduced it in the US, and then that incentive was going to roll off. So they've extended it. It's extended income tax cuts as well. So income tax, instead of being, say, call it your thresholds, 40% goes down to 38%. Childcare benefit, instead of being $1,000 is $2,000. But the big one is actually the ability for companies to expense capital expenditure. So if I go and buy something shiny, I can expense it day one instead of expensing it or amortizing it or depreciating it over a long period. So this is why you're seeing a lot of the big tech companies spending on the data centers, the AI, etc., because they can write this stuff off day one. And when you write it off, you reduce your tax bill, because I generate X amount of revenue and I pay X tax. Actually, I can deduct all this spending first before I pay tax on the rest. So there's a huge incentive for companies to go out there and spend on capital goods. And what we're seeing is that, it's not only the big companies that are doing this. Medium-sized companies say, well, I may as well upgrade that so-and-so, because now's the time I can reduce my tax bill. And what this does is this creates growth. So you're expected to see a boost to economic growth of almost 1% this year. That's a good reason to be optimistic. Second up, we have basically earnings growth. So how much are companies growing? And companies did really well last year, but they're expected to do even better this year. Why would they do even better this year? Well, they're doing even better this year because they can expense their capital goods. Secondly, inflation is coming down. So the cost of the stuff they use to produce whatever they're making has come down. Secondly, or thirdly, so then you have interest rates are coming down. And as they continue to come down, your cost of getting debt or borrowing, etc., reduces. Cost of mortgages, refinancing cars, all that kind of stuff comes down. So again, it's just another reason to be positive. And then you've also seen like the oil price coming down as well. And so what this means is that, look, earnings expectations are improving. So for the S&P, actually, look, expecting earnings to go up this year. Mid-sized companies, earnings to go up even more. Small companies, earnings to go up even more, because you're really going to get a kicker from basically those tax write-offs, your interest rates coming down, inflation coming down. And then the last thing is, it's an election year. So I think it's probably an understatement to say that we've had policy instability coming out of the US, particularly at the beginning of the year. Greenland, Venezuela, Davos, etc. But what I expect to happen is that the US administration, the focus will shift to the US as we transition through the year, because we have the midterm elections in November. And the midterm elections is just part of the election cycle in the US, where you have the House and the Senate. So these are the two fractions of the US government. And within the House of Representatives, there's 435 House representatives, and they're representing all the voters in all the states, and they roll every 2 years. So they're all up for re-election. And then the senators, they're on a 6-year cycle. So about a third of the Senate seats, and there's 50 Senate seats, they roll. So sorry, yeah. So we're seeing, the potential for a change in politics or a change in control in the US. And so that's something which will be a focus for markets this year, and a focus for the Trump administration. So what we expect is that they'll be looking to implement voter-friendly policies. And so you saw some kind of hints of this with the US government talking about capping credit card rates at 10%. And this is all about affordability for things like housing. Actually, I can put a deposit on a house then as well. Some people use their credit cards for that. And you did see that on the day that was announced, housing stocks in the US went up 20%. So, the Trump administration is very aware of the initiatives that voters value. And therefore, you should see more focus on domestic over international. And again, this is why the Trump administration has put key deadlines on getting certain things done, whether this is a peace deal with Russia, Ukraine. We need to get this done by this date, because he knows after that, he's got to focus on basically domestic economy. And he'll be going out on the road shows across every state and every rally and every conference and presentation. He'll want to be there, because that's how he works. So again, I think, look, that's a reason to be positive, because less focus on international, more focus on domestic, and that tends to be good for markets. Okay, so hopefully that's just given you a little bit of insight into last year and what to expect this year. And then I'll just give you a quick reminder of who we are, what we do, before we wrap up and see if there's any questions. I'll just say, look, we've got a really, really strong team here at Marlborough. The team continues to grow. We've got great experience. So somebody like Nick Peters used to work for Fidelity. You've got Eddie Kennedy was Credit Suisse. So we've got lots of big bank experience, lots of youth coming through as well. But ultimately, having a good team, structured process, that's how you deliver results. So we do believe in having a high-performing culture. This is just a quick recap on the performance of the 4 funds that we manage for our international clients. So this is the ICAV range. So we've got adventurous, balanced, cautious, and defensive. So good performance across the board since launch. And this is, just a visualization of that over a cumulative period. So strong performance for adventurous over 5 years. So we've got 54% performance, and almost 35% for the balanced Z share class, 34.9%, and even defensive 12.9% and 13.7% for the USD share class. And this is just showing you discrete performance, but I'm not going to go through that on the call now. And then just quickly on the asset allocation that we have, when you invest in something like an adventurous, you're getting a lot of equity in there. When you're in defensive, you're getting equities and fixed income and a small amount of alternatives. For us, alternatives are all about stuff which can really diversify your portfolio. Things like gold would be an example. And that's actually just all I wanted to go through today. So I'm happy to take any questions. I appreciate, as I always do, there's a lot of information there, but I'm happy to take any questions. And if anybody wants any follow-up, where we are. We'd love to speak to you.
Great. So thank you for that, Nathan. As ever, really useful insight to filter away the headlines and the emotion and focus on the real key fundamentals. And I'm sure plenty of material for advisors to share with clients on any upcoming review meetings that they'll be having this year. As expected, we provoked some questions from the floor. So in no particular order, first one would be for you, Nathan. What would you need to change in the data for you to turn materially more cautious from here forwards?
Yeah, so okay. Materially more cautious. So I think if we look at the AI companies, they're spending a huge amount on building out AI infrastructure. Now, If you saw that they weren't able to monetize that, weren't actually to make a return on that, then markets wouldn't like that. That's one thing that markets wouldn't like. So that's one thing we're keeping an eye on. So their ability to monetize that data. So we are seeing some instances of productivity increasing and companies able to reduce cost and increased earnings coming through as a result. But we're looking at that and continue to look at that. I think the second thing is the policy instability coming out of the US. I think a lot of it is it's all with a goal. There's a motive behind everything. Venezuela would be a good example. Look, the key motive there was around oil price and also to disrupt the influence that Russia and China has in the US region. So that's another key motive. So we're seeing that play out. But I think it's for them. Does the market fully grasp that, or do they just think actually Trump is essentially gone off the handle? So that would be other people's thinking of it. So for us, we think it's more premeditated. There's motive behind it. With a lower oil price, it reduces cost for voters. It reduces inflation. If you reduce inflation, you can lower interest rates. If you lower interest rates, everybody's better off from the voter base. So there's multiple motives there. And plus it removes the influence that China and Russia had in that region. So for us, we're going to watch the policy instability. We think we're past peak policy instability. We think January was obviously there was quite a lot of it. And we think he moves more domestically focused. And if he loses control in the House or the Senate at the midterm elections, that just means he'll have a lot more blockers in place and challenges. So that we're watching policy instability. And then I think if you saw inflation spike back up, but we just don't see any sign of that. But that would be another reason to be concerned. But yeah, we're always looking out for the potential risks on the horizon.
Great stuff. Another one here for you. Do you think that markets are becoming structurally more reactive to the headlines out there?
I would definitely think so. So I think it's almost a byproduct of this kind of fast twitch culture we live in. We live in a social media culture. We live in a culture where information is shared almost instantaneously. And what that does is it almost creates waves and trends and things which are in vogue for a period of time. And that period of time becomes quicker and quicker and quicker. And the attention focuses from here to here. So it can mean more swings in markets. Because people react to a certain thing, and then actually when people have realized what that was, it can move back as quickly the other way in a very short period of time as people actually recognize, digest it, and go, actually, no, it's this, not this. So I do think that just means that people should really consider how they react to markets, because a lot of things that markets are reacting to aren't worth reacting to, because the market itself is kind of overreacting. So I think that just becomes a feature of markets in the world we live in today.
Okay, and one says, thanks for the session, Nathan. How should long-term investors think about positioning when valuations feel stretched? Some PE ratios are very high, but fundamentals remain quite supportive.
Yeah, so think about it in this way. So I think if the tech companies ultimately are able to unlock AI and it has the potential that everybody has, those companies should theoretically be more expensive because their earnings in the future are going to be higher. So it's almost like we get this productivity leap, and therefore it structurally creates the potential for higher earnings. So therefore they should be more expensive. Now, if I look at the big companies that everybody's concerned with, they're getting cheaper because their share price haven't moved, but their earnings have actually improved. And so it just means that the P's for those companies have come down. And comparing them versus 2000, there's no real comparison today because they're at very elevated levels in 2000 compared to today. So I think with the fact that everybody's slightly cautious on the US is actually helping the PE multiple. And then the other thing to remember is that for most multi-asset providers, look, they're going to give you a diversified portfolio. So it's not all about US exposure. And even within US exposure, people can manage that too. So from our perspective, we've added in a fund which has more of a value bias. So it's investing in areas with cheaper valuations, more mid cap and more small cap in there. And so there's always opportunities in any market, even if some segments are expensive. So not all the market is expensive. So there's always opportunities. So for us, it's just about managing risk, looking for opportunities throughout the cycle.
Great stuff. And last but not least, are there any areas that investors are still under allocated in that could potentially surprise over the next 12 months? For example, lots of talk of moving out of the US and into Europe and even the UK.
Yeah, so I think, look, the UK is definitely benefiting this year. Why is that? So if you look at the UK stock market, you've got lots of energy names in there, mining names. We've seen a big tick up in energy prices this year. So that's definitely helped the UK stock market. You do get these rotations and they do happen from time to time. The reason the US leads is because of innovation. Innovation drives long-term growth. So that's the key driver there. But then I think for you do get short-term rotations, and that short-term rotation has been driven by policy instability. So for us, we are taking advantage of that. So one area we've gone overweight is emerging markets because they look more attractive this year, and you are seeing a benefit from pickup in commodity prices in emerging markets. So again, we do look to play that, and even in areas where you can get concerns from time to time, like the US, we can manage that too through the positioning within the US.
Great stuff. Well, thank you to everyone for the questions from the floor. And thank you, Nathan, for the session today. As Nathan said, you can access the range of Marlborough investments via the Novia Global platform. And if you need further details, you can find them directly on the platform or via your usual international sales manager contact. As ever, the recording will be available within the next 48 hours. So if there's anything you want to go over and review again, you'll be able to do so at your own leisure. And indeed, if you have any colleagues who you feel may benefit from looking at the session today, please feel free to share with them as well. Just leaves me to thank Nathan once again, and keep an eye out in your email inbox for the next Pulse newsletter and the invite to the next webinar. And if you don't do so already, please follow us on LinkedIn to keep abreast of all the updates from Novia Global. Thank you very much for your time today, everybody. Goodbye.
Thank you.